Good morning and welcome to this Wednesday, March 17th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it is Fed Day today. This is going to be an interesting policy statement, given all of the renewed fears of inflation, higher interest rates, and so forth. I think the Fed, they're not going to do anything. There'll be no change to interest rates today, but the market will be literally, sitting on every word that Fed Chief Jay Powell has to say, and that's going to have at least a short-term impact on the market. So 2 o'clock today, you can expect probably more volatility. Many times the first move at 2 o'clock is not necessarily the right move. Many times there are a lot of head fakes. So normally by the end of the day or into tomorrow, we'll have a little bit better sense of the reaction. But what makes this this particular meeting more interesting to me is the fact that we have options expiring on Friday. So this is coming just a couple of days before options expire. And of course, we've seen, pretty wide, diverse type of reaction in the market over the past month or so with higher interest rates. Obviously, many of the areas like financials have done extremely well. Many of those value stocks have performed extremely well, while many of the growth stocks, technology, some of the areas within consumer discretionary, they have not performed nearly as well. And it set up something pretty interesting as we went over last night, our Max Payne webinar, in that you've got, companies on both sides of the spectrum here. As we head into options expiration, you've got the value stocks, which generally in the past, we've been looking for moves higher into option expiration because they've been lagging. But this particular month, it's the opposite. Value stocks have been leading. So they're the ones that have a lot of in the money call premium. And technology, on the other hand, is an area which had been leading in the past. So obviously there was a lot of downward pressure on those stocks as we headed into option expiration week. And now many of those stocks, because they've underperformed, are not in the same, that same category in March that they were back in February, January, and so forth. So this is going to be really interesting to see what happens. As I said recently, I suspect that we're going to see the Fed talk about, I think they're going to remain cautious. I think they're going to say, hey, we're seeing some improvement in the numbers and so forth. But I still believe that they're going to hold off on talking about interest rate hikes any sooner. They're probably going to say something about it. Obviously, they're going to monitor it. But Wall Street's going to look at every word they say. It's not, they're not looking at actions. Folks are not looking for actions from the Fed. They're looking at their language, which can make it kind of tricky. And then you've got options expiring just a couple of days, which makes it even trickier. So this is going to be a very interesting week. Let me just say that. But before we get into yesterday's action, let me take you over to our website at Earnings Beats. If you're not already an Earnings Beats subscriber, it's free. Just simply Earnings Beats Digest subscriber, I should say. That is a free newsletter. Simply type in your name, email address, hit the subscribe button. We'll add you to our community of traders. It is published Mondays, Wednesdays, and Fridays, typically before the market opens. So normally by 8:30, 8:45, something like that, you'll have it in your email. And normally that just focuses on one topic. It could be, relative strength, earnings, an individual stock looks good from a trading perspective. This morning, we actually had an RRG in there looking at small cap technology. And it was an ETF, the PSCT, and the top 10 holdings in that ETF and how they all look on an RRG. So try to make it educational, try to use a lot of the tools that are available at stock charts to widen our base of knowledge and hopefully give you some good information as you approach the trading day. If you'd like to try, try our paid service, you can click on the green Join Today button. That'll get you a 30-day no-cost trial. You are charged $7 up front, but that's refunded within the first week. And you can check out all of our research, all of the chart lists that we have, the scanning strategies that we use, or some of the basic scanning strategies that we use. You can look at the stocks in our portfolios. As I mentioned, growth stocks not really in favor right now, and as a result, 3 of our 4 portfolios, which focus more on the growth side, clearly lagging. Still, 2 months to go, a little over 2 months to go before the end of this quarter. So we'll see how things play out. I suspect once the focus turns back to earnings, we're going to also see the focus turn back to growth stocks. But March, historically, not a great month for growth stocks. It is a good month for defensive areas of the market. So I think some of what we're seeing, we've seen in the past historically. So I think the key is going to be what happens when we get into April and we start heading toward earnings season. I believe we'll see things turn back around. I'll talk in a few minutes about the technology ETF, the XLK, because I think that could be setting up in a pretty bullish pattern, but I'll get to that in a minute. Anyhow, I'd love to have you try us out if you're not already a member. All right, let's move on to what happened yesterday, Tuesday, March 16th. The Dow Jones, you can see, did fall 127 points, got up close to that 33,000 level. Haven't been able to close above it yet, but got close and then pulled back. We saw the same thing back at 32,000. So it's not unusual when you get to these psychological levels. And with options expiring, I think there's also still a 60-minute negative divergence in play for that large cap index. So a little bit more selling on the Dow certainly would not be surprising, especially as we head toward option expiration Friday, or possibly even into the early part of next week. S&P 500 down 6 yesterday, also threatening a very significant psychological level at 4,000. Not quite there yet. We did turn around and like the Dow with the options expiring this week. I think this is going to be a difficult time to see the S&P 500 break above 4,000. I don't think it will happen this week. Earlier in the week or late last week, I was thinking maybe we'd get a run for it, maybe even break out above 4,000. We'll see what happens, but with options expiring, that's going to make it more difficult. But then you've got the Fed throwing another curveball in there. Nasdaq finished up 12, but it didn't feel like it. It was up a lot more earlier in the day and reversed, and it also reversed at a key level. If you notice, we had that ABC correction, and the A and then the B. That B went up to about 13,700. And when we fell back down to 12,400, when we came back up, we got almost all the way back to that level. So it's starting to look like an inverse head and shoulders to me, which means in the short term, we could see a pullback to around 13,000, maybe 12,900, 13,000. And then reversal there and a breakout would be extremely bullish for the NASDAQ. But, I'm projecting what could happen. Let's see what happens. Mid caps down 1.3% yesterday, weak, very weak, and small caps were even weaker, down 1 2/3%. But these have been the 2 strongest areas. So pulling back isn't a shocker. We'll see again what the Fed has to say, how these groups react to the Fed. I think that's going to be important. Communication services was the leader yesterday. Technology also had a good day, but like the NASDAQ, pulled back quite a bit from the earlier high. You can see it was up to 135, finished at 133.81. So it didn't feel nearly as bullish as it might sound looking back. But those were your 2 leaders, communication services and technology. Energy was down. I did see crude oil down about another 1% this morning to about $64 a barrel. We'll see what kind of impact that has for energy. But this is a group that could be subject to some problems with option expiration, just because we've had such a big run up from 40 to 55 in just the last 6-7 weeks. That could have a lot of energy stocks, those that are optionable. Many of them could be deep in the money. So you want to be careful, maybe check options on the stocks you're holding, see if there's a lot of in the money calls and not a lot of in the money puts. And if that's the case, you might want to be a little careful here in the near term. Industrials also could meet the same fate. We were down 1.4% yesterday, so a pretty rough day. Did come down off of that top up near 98. And another industry, another sector, I should say, that's had a really strong 6-7 week run. So got to be careful heading into options expiration if your stocks have been running and they're optionable. Semiconductors had a good day, but we did finish near the low of the day. So like technology, like the NASDAQ, didn't feel quite as bullish as it might look on the chart, up 1.25%, not bad. But you got to worry a little bit about this downtrend line, the fact that we failed to extend those gains throughout the day and we closed near the low. that type of reversing candle can lead to some short-term struggles. Maybe the first test is going to be these moving averages. We got back up through them. Can we hold? If we don't, and we go back down below, then you've got to be looking at this as sideways consolidation. Right now, I'm looking at it as, okay, we broke up above those moving averages. We could be trending higher, but if we are, we need to hold these moving averages on the pullback. So depending on how, how things go later today, that's going to have a pretty big impact, I think, on the more intermediate term for semiconductors and technology stocks. I can tell you right now that in the pre-market, Nasdaq futures are the weakest, down about 1%, 139 points. Dow Jones up 56. This is, I think, probably about as of 10 minutes ago or so. I think what I look at is on a little bit delay. I don't think any other news has come out, but we could be a little bit off of those numbers. But the point is, Nasdaq futures are under pressure. It looks like Dow futures are pointing north, and we'll see what happens when the Fed announcement comes out at 2 o'clock today. Again, this is going to be a very interesting day. 10-year Treasury yield. Well, this has been the news, part of the news, and it's more news again today. Trying to get this update, make sure we get the latest here. We're at 1.66% now. If we had looked at this 3 years ago and said, hey, we're going to be at 1.66%, I think just about everyone would have been jumping for joy to have such low rates. But it's all about perspective. And we were down at 0.5% back in August. Back last, in March. Let's go back just a little bit further here. You can see in March that low went down to 0.39. I think it was 0.4. Then the August low was 0.5, and now we're up to 1.66. So yes, there's no doubt interest rates are on the move higher. But I think interest rates were artificially low because of the pandemic. I mean, once the selling started and we lost support up at about 150, 155, it was straight down. So the fact now that the economy is strengthening, it seems like the market is beginning to price in the end of the virus. We're right back about to where we were, which I think is kind of just normalization. That's what I refer to it as. I don't think that it's necessarily because of inflation. I don't think at this point it's even necessarily because of future growth down the road. I think we could go higher. I think 2%, certainly not a stretch. Do I think we're going to be at 4%? No, I don't think that at all. I don't think inflation is going to be a problem. I think we're going to see some headline numbers that'll probably scare everyone next couple of months. But beyond that, I think we'll kind of return to a normal inflation target around that 2% level that the Fed's looking for. And so I don't see inflation being a problem, but that's just me. I know there are a lot of folks that are calling for a lot more inflation out there, and we'll see what happens. I think the Fed is watching it closely. I think if they act early, if they talk about acting early, I'd think it will be more because they're concerned about inflation. They can say what they want. But if they do talk about raising rates earlier than anticipated, to me, it's they either have to say, hey, we're seeing tremendous economic strength ahead, or then they're saying, hey, maybe we are a little concerned about inflation. So that would be one thing in the policy statement at 2 o'clock that I'm going to be watching for is the timing of these interest rates. Have they moved them up? And if so, why? Those two things I think would be pretty critical to how the market's going to react later today. All right, as far as economic news, we had a horrible day of economic news yesterday. You would have thought that the 10-year Treasury yield would have dropped 20 basis points after some of the numbers we saw, retail sales. But again, you got to smooth it out. Retail sales yesterday were minus 3%, which is a huge drop. But January, they were up 5.4%. And I think if you strip out autos, they were up 5.9%. So again, keep everything in perspective and kind of smooth it out. I think if we didn't have this pandemic, we were sitting at 1.7% in the yield a little over a year ago. Now we're at 1.66. No one would think anything about interest rates. But the falling rates were bad for the market. Now we're trying to be convinced that the rising rates are bad for the market. It can't be both ways. So I think we're pausing, especially technology, because of the rate increase and because of the inflation talk and so forth. But I think when that begins to subside, I think technology growth and so forth become leaders again. I don't think they're going to swamp value. I think everything's going up. Now, unlike what we saw back in 2020, where many of the growth stocks went up while many of the value either went down or simply just couldn't catch, their footing. I don't think it's going to be like that. I think going forward, the beauty of this, especially with our portfolios, is we're going to have a lot of choices to pick from. We'll be able to find leaders in a lot of different areas of the market, which I'm really excited about. It's not going to be narrowed just to a couple, 2 or 3 parts of the market. So I think that'll be a really good thing. But in the meantime, while we're transitioning and rotating, that's what's creating a lot of problems here. All right, let's take a look at technology, because I pointed out earlier that I thought this was in a fairly bullish pattern. So let me annotate this and show you what I'm seeing. Now, first of all, patterns don't confirm until they confirm. I mean, you can look at something and say, this looks like a bullish pattern unfolding, or this looks like a bearish pattern unfolding. But until you actually get the breakout or the breakdown of that pattern, it doesn't confirm. Now, I know a lot of folks want to always talk about bearish patterns. I don't believe in looking at bearish patterns in a secular bull market, because in a secular bull market, prices continue to go higher. So I think it's wasted effort until we actually see the pattern develop and then break down. Then I'll start looking at it. But when a bearish pattern sets up, that isn't necessarily going to, it's not going to make me feel more bearish about the market. However, when I see a bullish pattern develop, I do get more bullish, because I believe we're in a secular bull market. So I'm looking for those patterns to develop. So let's take a look first at this ABC correction here. So there's your first move down on technology. And then we had, let me just do it this way. Then you had your second, there's your B. And then we came down right here for your C. So there's your ABC correction, which is, you don't see it every week, every month, every quarter. But when you get it in a market that's moving higher, that shouldn't be overly concerning. I mean, obviously it doesn't feel good when it's happening, but it also gives the stocks a period of cooling down. It gives a period of folks that are, the weaker hands in the market that are chasing stocks to the upside. When they get involved in something like this, they're getting out, they're selling, creates more selling. And you've got to get to a point where the selling is more or less exhausted itself in the near term. And so once you go through this ABC pattern, a lot of times you'll start to see the areas of the market or the market itself begin to correct itself. And so as we moved up, the bearish development, or what I would have expected from a bearish perspective, is a failure at the moving averages and then a new low. But instead, we actually went through the moving averages, made our way all the way back up to where we put this high in on the B. So now we've got this next move up from here. And so, but we went all the way back up to here. So what I'm now seeing is maybe a left shoulder, left side of a neckline, the head, the right side of the neckline, and potentially as we go into option expiration week and we, round out March, perhaps, and I don't know if it's going to be that steep. Well, for the pattern, it would be best if it's not that steep, but we could be looking at a move back down to, say, this 128 level. We're at 133 and change. That would put in a right shoulder. And then as we move toward the end of the month and we start thinking about earnings coming up in a few weeks, what would be very bullish is to see all of a sudden that transpire on the other side. Now, again, I'm speculating. I'm looking at the chart, thinking about what could happen. It didn't quite develop this way back in September. Here we had a move down, bounce back up, one more move down. So it was a little bit of an ABC correction here. Went up through the moving averages, came right back down through the moving averages, put in almost an equal low, and then started moving our way. So this was more sideways consolidation. This is an inverse head and shoulders that I'm talking about. It could turn out that we go back down to this level right here. Very difficult to say. I mean, I don't know what the market holds in store for us. But I do know that I believe we're in a secular bull market. So I start looking for bull market type patterns. Now, if we go back down and we lose the low in March, then I think it's time to reevaluate. Not that I'm going to say, hey, we're in a bear market, but obviously this is more than just an ABC correction at that point. And so we'd probably need to consult the weekly charts and start looking at the weekly charts as to, how the chart looks, where we might be headed. So if you pull up that weekly chart, now remember that was like around, on the daily chart, it was around 125 support. Now, if you look at the weekly chart and annotate the weekly chart, you'll also see that 125 is about where we had broken out from these prior highs. Came down, tested 125. If we do go back down to 125, it's kind of a key support level. Now, if we fail, that's going to chase a lot of folks out of the market. We do have a negative divergence on the weekly chart, although the last few months we're starting to see that turn back up again. This is kind of a stretch to compare PPOs this far apart, in my opinion. And the reason why is that the PPO, the default setting is 12 and 26 weeks. Well, what's 26 weeks? That's half a year. That's 6 months. So by the time you get to PPOs that are 6 months apart, there's no common data in the 12 or 26 period. You're looking at, to me, at apples and oranges. Now, this is just my opinion and my interpretation of the PPO. Everyone's entitled to look at it however they want. But I believe that you go through periods where you reset. Now here, we didn't reset back at zero, but we did consolidate for a while. And then it looks like we're starting to turn back up again. So normally when that happens, I look for the rising 20-week or 20 period moving average to hold. And so far it has. So when I'm looking at this chart on the weekly, I'm not really seeing anything horrible. I'm seeing a 20-week test, which is very normal during an uptrend. I mean, if we got scared out of technology every time it tested its 20-week, we would have missed some huge runs to the upside. So I think it's way premature. I know it's felt horrible. It always does when technology sells off, or when the Nasdaq sells off, or when anything you own sells off. But I think it's important to keep things in perspective. Bring up that big picture from time to time, like the longer term weekly chart. Bring up that S&P 500 100-year chart and look at that. That does not look bearish to me at all. It looks very, very bullish. All right. So anyway, I wanted to go into that because I do think technology is in focus right now. Obviously, a lot of technology stocks have not done well, but part of it is they don't do well in the third month of a calendar quarter. Once we get past earnings season, there's not a lot. They've already made their runs. You see profit takings. I think profit taking, you see institutions, I think, that move out maybe a little bit of their positions, maybe add little defensive areas. And as a result, you see defense pick up for a while. And then as we go into earnings season, I think for the most part, we tend to see that flip back. So like I said, the way I feel about the market right now will be different than the way I feel in a month. Let's see what happens through earnings season and see where we are. I think that'll tell us a lot more about where we're heading. All right. I thought maybe what we would do for a minute is just take a look at global markets. I haven't looked at them in a while, but I think it's important to let's go back and look at maybe the long-term 15-year chart. And if you look first, the German DAX, we've broken to an all-time high. The DAX and the S&P 500 have the strongest correlation, positive correlation of any of the global indices. If you're looking for what's likely to happen in the U.S. and you want to clue outside of the U.S., look at the German DAX. The correlation tends to be very, very strong. So this is just another bullish sign to me that we've got the German DAX breaking out. But it's not just the German DAX that's been performing well. I mean, we can go around the globe. Here's the Tokyo Nikkei. Double, triple top right here. We broke out in the fourth quarter of last year. I mean, we are soaring. Now, we're not at an all-time high. I did make that mistake talking about it because I only went back 15 years. But you'd have to go back a long time to get to the all-time high on the Nikkei, which is all the way back in 1989. But if you look across here, we're now trading at the highest level we have since 1991. That's a 30-year high. I think that's pretty solid high. I'll keep it on a 40-year chart here. Let's take a look at the Hang Seng. Hang Seng, see this top here at about 32,000? Then you got this top at 34,000. Well, we're starting to make this move. Monthly PPO has gone positive again. we'll watch it, but I think you can see that clearly over time, this looks like an uptrending chart, but we do have a couple key levels we have to take out. Things are looking better. I think we're going through both those levels, but we need to see it first. Then you've got the Shanghai composite. And I think overall you see this moving higher, but you had major peaks back in 2007 and again in 2015. We got a lot of work to do here. Sometimes you'll hear on CNBC, well, something is not going right in China. You know, that's probably not good for us. I would disagree with all of that, simply because China, when you look at the correlation between the Shanghai and the S&P 500, it's all over the place. There is no consistent pattern one way or the other with correlation. Much stronger correlation with what's going on in Germany. So pay attention to the German DAX more so than the Shanghai composite. That's just my opinion. And then if we want to look at something like the emerging markets, the EEM, check out the breakout here. I mean, it's not just that. I mean, we could go through all of our major indices here. How about the small cap index, the S&P 600 small cap index? I mean, since the low last year, this thing has been straight up. Or what about the mid cap, the S&P 400 mid cap? Same thing, breaking out. S&P 500 breaking out. I mean, I hear a lot of folks saying, well, this can't last. I don't know how to answer that except to say, you know what, if it breaks down, we're going to see it break down. I heard someone say the other day, the Dow and the S&P are going to lose 90% of their value. And I'm just, you know, that is just taking a really bearish. I mean, how many times have we done that in our entire existence? Once, 1929. That's the only time. So if you're calling for that, you might not live to see it. You know, no one may live to see it. We may never see anything like 1929. Remember, that was back before the SEC, before we even had the Securities and Exchange Act and so forth. That, to me, was a completely unregulated, different period than what we have today. The Fed stays on top of things. Do they get it right all the time? No. Do we get excesses from time to time? Yes. That's going to continue. But I don't see these massive drops that people talk about. I just don't see it. Anyhow, let's keep moving on. I want to maybe take a quick look at a couple of stocks that we talked about yesterday in our Max Payne webinar. One was Alibaba. Now, this is a stock that's been hit really hard. It was 275 just a month ago. Now it's 220s, 220s. You can see this recent support about 226, 225, and then again down in the two teens. There are a ton of calls, or excuse me, puts. There are a ton of puts on Alibaba, a lot of in-the-money puts. It would behoove market makers to see prices move back to the upside. So this is a stock just to watch for options expiration. You know, maybe just track it this week and maybe into early next week, just see if it bounces at all. But Alibaba is one I wanted to point out. Another one I wanted to point out was Carnival Corp. Of course, the cruise line, CCL, because now we got the opposite thing going on here with the move up. We had a big reversal yesterday, negative divergence. And Max Payne here, I think, is down around $23, $24. And it's sitting at 28. So what does Carnival do over the next couple of days or into early next week? That's going to be really interesting to follow as well. And then we got the Fed coming out. I'm telling you today, you might want to just strap on your seatbelt, maybe put on a crash helmet, because it could get very volatile, not just today, but over the next week, I would say. Things could be crazy with all the inflation talk, interest rates, options, back and forth. And then the next thing I would look for over the next couple of weeks is look to see if we're getting any lowered guidance by technology stocks. If we're not, or you know, maybe even into the first week of April, if you're not seeing any companies coming out and warning, that would be another sign to me that we've got another strong earnings season coming. Anyhow, let's go to dashboard. Let's do a quick 3 you must see. I'm going to pick, let's just pick the 3. How about the top-down scooters on the large cap? Haven't even looked. Let's take a look at these three. So first we've got NOV, which is National Oil Well, or Oil Well, Varco. You can see the breakout. I would have expected the 20-day to hold here, and it didn't. In fact, continuing to go a little bit lower. Oh, it's 9:30. That's today's candle. Oh, I didn't look to see what the other stocks were. And of course, they're going to be gone. One was Chewy. Anyway, NOV, I would watch that 50-day. You can see the recent low that came down here to 14.5. That needs to hold. Otherwise, this breakout could be negated here. So I'd be a little careful with that one. The second one I know was on the list was Chewy. I'm not sure what that third one was. Chewy broken down. This one was kind of a weak bounce. Breakdown below the recent low around 75 to me would be very bearish. You can see here the PPO barely even budged back to the upside. This one doesn't look as good as some of the others that we've seen bouncing back to the upside. So Chewy looks a little bit more, I'm a little more skeptical. And I would say the area to watch longer term would be down at around 70. You had the tops coming in here at about 70 to 75. Here was a bottom at 70. Here was a bottom at 75. So just looking back over the last few months, I think that range is something maybe to think about. All right, let's see what else. Let's do one more for the three you must see. Let's look at PNC. It's in the banking area. Should be, it's looking pretty good. We're struggling a little bit up here at about 180. Not too surprising after making a big move. I would say this, be careful with PNC, especially if you see a false breakout. Let's say it goes to 182 today, 183, and then comes back down and maybe prints like a gravestone doji where you have a long tail to the top and you finish back down at the open. Be careful because PNC probably has a lot of in-the-money call options. And with, again, the Fed announcing later today and options expiring Friday, a stock like this to me it could be extremely aggressive and volatile over the next few days. A 20-day test certainly would not be a surprise at all. And that would be $6 from here. So again, if you get up to 182 and you fail, you come back down, just be careful in the short term, because if all of a sudden the Fed says something and interest rates drop quickly, you could see a lot of these banks taking a big hit and all of a sudden all of that in the money call premium disappearing. We see it every month. Wouldn't be surprised to see it here with the banks. So just be careful there. All right, let's get a quick update on what's going on here. See if Nasdaq still down that 1%, pretty weak. Dow showing a little relative strength, relatively flat. And then the S&P 500 also down. One thing we did point out in our Max Payne session yesterday is that both the S&P and the Nasdaq do favor a push to the downside here in the near term because of the way options are on the spider and the Qs. So we're going to have quite an exciting week, maybe even week and a half ahead until we start moving more toward the earnings season. So let's see what happens. It's going to be very interesting to see what happens after 2 o'clock today. Listen into that Fed policy statement, and then let's look at the reaction to what happens. Another thing I'll be looking at the reaction to is the IWF, IWD, seeing what happens to that ratio after 2 o'clock today. Anyhow, that's it for me. Everybody have a great day. Be back tomorrow at Stock Charts for the next recorded version of Trading Places Live. Hope to see you there. Everybody have a great day. Happy trading.